What if the biggest thief in your investment life isn't a market crash, but the very people you trusted with your money? Wall Street smiles, promises riches, and quietly takes trillions from hardworking families, year after year, decade after decade. I spent my entire career fighting that theft. My name is Jack Bogle, and today I'm going to tell you exactly how to stop it with radical, unbreakable simplicity. My friends, let me take you back to where it all began for me. I was born in 1929 in Montclair, New Jersey, just months before the stock market crash that plunged the world into the Great Depression. My father was a hard-working man who lost his business, our home, everything we had. We moved from house to house, scraping by. Those early years taught me something profound. Money isn't abstract. It represents sweat, sacrifice, security for families, futures for children. When it's taken unfairly, it's not just numbers, it's wrong. I clawed my way to Princeton University on scholarships, graduating in 1951 with a thesis on mutual funds that already questioned whether most could beat the market after costs. The industry laughed then. They're still laughing less now. After a stint in the Navy, I joined Wellington Management in 1951, rose to chairman, but was fired in 1974 after a merger gone wrong. That setback? The best thing that ever happened to me. It forced me to start Vanguard, the first mutual company truly owned by its funds and investors, not by outside profiteers. Vanguard began with almost nothing. No advertising budget, no sales force, just an idea. Serve investors first, keep costs rock bottom, give them their fair share of market returns. In 1975-76, I launched the world's first index mutual fund tracking the S&P 500. The press called it Bogle's Folly. Who wants average, they asked. My answer, everyone should want average, because after fees, that's better than what most get. Here's the core deception Wall Street sells. You need them to beat the market. You need active management, stock picking, market timing, hedge funds, star managers, hot sectors, tactical allocation, alternative investments. Each comes with high fees, 1%, 2%, sometimes more, plus hidden trading costs, taxes from turnover, sales loads. They promise outperformance to justify it. The reality, arithmetic crushes the promise. All investors together own the market. Before costs, the average return is the market return. Professionals are the average, smart people competing against each other. Their gross results cluster around the market return. Subtract their costs, and most fall below. Add individual investor behavior, buying high on greed, selling low on fear, and the gap widens dramatically. Decades of data confirm this. SPIVA reports from S&P Dow Jones indices show year after year. Over 15 years, 85 to 95% of active U.S. equity funds underperform their benchmarks after fees. Over 20 years, even worse. Morningstar, Dalbar, academic studies all reach the same conclusion. The longer the period, the more costs compound against you. Why does simplicity win? Because it eliminates what kills returns: unnecessary complexity, high expenses, emotional mistakes, manager risk, style drift, sector bets. A broad market index fund owns thousands of stocks, big, small, growth, value, every industry. No single failure destroys you. You get the full market return minus a tiny expense ratio, often 0.03% to 0.05% today at Vanguard and similar providers. As I've repeated endlessly, don't look for the needle in the haystack, just buy the haystack. The haystack is the total stock market. It includes every publicly traded company. Winners and losers balance out. The economy grows over time. Businesses earn profits. Dividends flow. Prices rise with earnings. You participate fully. Investment versus speculation. This distinction is crucial. Investment means committing capital to productive enterprises for the long term, accepting the returns those enterprises generate. Speculation means trading pieces of paper, betting on price movements, trying to outguess others. Day trading, options, crypto hype, meme stocks, timing the Fed, pure speculation. I've always rejected it. The stock market is a giant distraction from the business of investing. My philosophy rests on 5 pillars: simple, interlocking truths. Invest, don't speculate. Own businesses forever. Enjoy capitalism's fruits. Minimize costs relentlessly. It's the only true free lunch. Every basis point saved compounds forever in your favor. Diversify broadly and sensibly. Eliminate avoidable risks. Stay the course through all markets. Discipline beats intelligence. Focus only on what you control. Savings rate, costs, allocation, behavior, not tomorrow's returns. These aren't opinions pulled from thin air. They're forged in 65 years of watching markets, studying data, talking to investors who succeeded and those who failed. They work because they align with reality. Markets are mostly efficient, costs are certain, time rewards patience, emotions destroy wealth. Let's do the numbers slowly and clearly because understanding them changes everything. Assume the stock market delivers a long-term real return of about 7% annually after inflation. That's historical average from dividends plus earnings growth minus nothing fancy. Nominal returns have been closer to 10-11% over many decades, but let's use conservative 7% real to keep it honest. Start with $10,000 invested at age 25. Hold until age 65, 40 years. At 7% compounded, $10,000 grows to approximately $149,744. That's your fair share if costs are zero. Now introduce realistic costs. The average actively managed equity fund expense ratio hovers around 0.8–1.2%, but add portfolio turnover, often 50–100% annually, trading commissions, bid-ask spreads, taxes and taxable accounts, and possible 12b-1 fees or loads. Total drag easily reaches 1.5 to 2.5% per year for many investors. Take a modest 2% annual drag, your effective return drops to 5%. That same $10,000 grows to only $70,400, more than half, $79,000 gone. Not lost in a crash, stolen by compounding costs. Make it 1% drag, very conservative for active funds. Net return 6%, ends at $102,157. Still $47,000 less, nearly one-third of potential wealth evaporated. Extend to 50 years, age 25 to 75, common for legacy planning. At 7%, $294,000. At 6%, $184,000. At 5%, $117,000. The differences become staggering, hundreds of thousands, even millions for larger sums or higher savers. This is the tyranny of compounding costs I've warned about since the 1970s. The miracle of compounding returns is overwhelmed by the tyranny of compounding costs. Every dollar paid in fees is a dollar that never compounds. It's gone forever. Why do active funds carry these costs? Because they try to beat the market. Research teams, analysts, traders, marketing, profits for owners, all paid from your pocket. Yet the evidence is brutal. After fees, most underperform. SPIVA data. 15-year periods show 88 to 92% failure rates for U.S. large-cap active funds versus S&P 500. International small-cap bonds, similar patterns. Even star managers fade. The few who outperform short-term rarely sustain it. Survivorship bias hides the failures. The industry promotes yesterday's winners. Tomorrow's are unknown. Contrast with indexing. A total stock market or S&P 500 fund at 0.03–0.05% expense ratio. Almost all market return captured. No turnover drag. Holdings change only when index reconstitutes. Minimal taxes and tax-advantaged accounts. Pure ownership. Vanguard structure makes this possible. As a mutual company, the funds own Vanguard. No outside shareholders demanding profits. Costs passed back to investors as lower fees. That's not charity, it's structural integrity. Diversification amplifies the advantage. One stock? You can lose everything if it fails. Enron, Lehman, Wirecard. One sector? Tech in 2000, energy in 1980s, broad index, thousands of companies. Risk reduced to market risk only, the risk you're paid to take. Volatility? Normal. 2008. S&P fell 37%, recovered fully by 2013. Those who held low-cost indexes prospered. Those who timed or chased safer, active funds often lagged. 2020 COVID crash, 34% drop in weeks. full recovery in months. Patient index investors won again. Short-term noise, headlines, Fed moves, elections, AI bubbles in 2025, 2026, distracts, long-term ownership rewards. My advice remains unchanged. Buy a total world or total U.S. stock market index fund. Add international exposure if desired. Balance with bonds, age-based, e.g. 110 minus age in stocks. Reinvest dividends, dollar cost average new savings, rebalance sparingly. This approach isn't thrilling. No cocktail party stories. But as I've said, be bored by the process but elated by the outcome. Vegas excites during the bet, bores with the loss. True investing excites quietly at the end. Markets are emotional roller coasters by design. They test resolve. Crashes arrive unannounced. Black Monday 1987, 22% drop in one day. Dot-com bust 2000-2002, 49% loss. Financial crisis 2008, 57% peak to trough. COVID flash crash 2020, 34% in weeks. Inflation bear 2022. Each time, fear dominates headlines. This time it's different. Sell before it's too late. Greed does the opposite. Bubbles form. Tech 1999, housing 2006, crypto 2021, perhaps AI in recent years. This time, it really is different. Buy more, leverage up, both destroy returns. Dalbar's annual studies show the average equity mutual fund investor underperforms the S&P 500 by 4 to 6% annually over long periods, entirely from bad timing. They buy after runs, sell after drops. My antidote: don't just do something, stand there. Once your portfolio is sensibly allocated, low-cost broad indexes, appropriate stock-bond mix, step away. No daily checking, no reacting to news, no chasing performance. Rebalance once a year if drift exceeds 5 to 10%. Otherwise, hold. This requires faith in three things: history, markets recover; arithmetic, ownership beats trading; human nature, most can't resist temptation. I've seen too many smart people fail because they couldn't stand still. What really matters in the end? Not beating the next guy, not headlines. Reaching your goals, a secure retirement, college for grandchildren, ability to give to causes you love, time with family without financial worry. I titled one of my books, Enough for a Reason. Too many chase more money, more status, more outperformance, losing sight of what's sufficient. I gave away much of my own wealth, scholarships at Blair Academy and Princeton, donations to medical research after my heart transplant. I wish I'd given more sooner. Money is a means, not the end. To young people especially, and I know many watch these talks, start now. Time is your greatest asset. Even small regular savings compound powerfully. A 25-year-old investing $5,000 a year at 7% real reaches over $1 million by 65. Delay to 35, less than half that. Ignore Wall Street noise, read my books if you like. Common Sense on Mutual Funds, the little book of common sense investing. But act simply, low-cost index fund, automatic contributions, hold forever. If I could speak to my 22-year-old self at Princeton, trust the data over opinions. Fight harder for investors earlier. Stay humble. Mistakes teach most. My firing from Wellington? Painful, but it birthed Vanguard. In 2026, amid whatever turbulence, rates, geopolitics, tech shifts, principles endure. Indexing delivers for those who wait. Your practical first step today: assess your current situation. Debts paid? Emergency fund? Open an account at a low-cost provider, Vanguard, Fidelity, Schwab, similar index funds. Choose a total stock market fund, VTI, VTSX, or global equivalent. Add bond fund if needed. Set up automatic monthly investments. Dollar cost averaging smooths volatility. Commit. No selling in panic, no chasing fads. Review once a year. Thank you for spending this time with me. This is day one of our 50-day journey through my ideas. Tomorrow we explore why I always said, don't just do something, stand there. Until then, own the haystack, stay the course. And remember, in the end, enough is enough. God bless you, and good investing.